Fools, exchange-traded funds have taken the investing world by storm, but a number of investors don't really understand how they work. How exactly do ETFs work, and how can you use them to make your portfolio returns even better than they are? My name is Dan Caplinger. I'm the Motley Fool's Director of Investment Planning, and today I want to take a look at ETFs with an idea of trying to get a sense of what they can do to help you. Now, basically, ETFs are a lot like their mutual fund cousins. They both represent small shares of broader portfolios that let you get diversified exposure to a certain asset class with a relatively small investment. But there are some subtle differences to the way that ETFs work. And basically the biggest one is that ETF shares are available for buying or selling throughout the trading day, as opposed to mutual funds that were only available to buy or sell at the market close. And that gives people a lot of flexibility. But it also presents a potential challenge because with ETF shares, you're never guaranteed that you're actually getting the value of the underlying assets when you buy or sell shares on the open market. Basically, that turns to the way that ETF shares are created and redeemed. Basically, with ETFs, you're never working directly with the mutual fund company. Instead, you're working with what's called an authorized participant that's able to create or redeem shares of the ETF at will. Now, depending on the ETF, the way that system works differs. So with an equity-based ETF, basically you're talking about companies either coming up with cash or stocks in order to exchange for the ETF shares. With an ETF like the iShares Silver Trust or the SPDR Gold Trust, what you'd be talking about is giving gold or silver bullion in exchange for ETF shares. And basically the arbitrage process helps to keep those prices in line. But what that means is that you have to have an ETF that is traded frequently enough to give authorized participants the incentive to keep those prices in line. Otherwise, you might not be getting fair value when you buy or sell ETF shares on the open market. And that's why it's generally a good idea to stick with the most liquidly traded ETFs in the market. ETFs like the SPDR S&P 500 or the Vanguard Total Stock Market that have a lot of trading happening to keep those prices in line. But if you're smart about the ETFs you pick, they can really give you diversified exposure, help you create a portfolio that will meet your needs for the long run. Now, for more on ETFs and smart investing, be sure to stay tuned to Fool.com for more tips. Thanks for watching, and Fool on!